of this brings me to a really interesting study that asks the question, with stocks trading at the levels they currently are, what would it take for us to see a repeat of the last decade's performance? Or basically, how likely are we to see another decade of 12.8% annualized returns that so many people have grown accustomed to? Well, to answer this, the author makes the point that these last 10 years have been exceptionally good for investors, coming in well above the 90th percentile of rolling 10-year performance since January of 1950. He summarized that much of this has to do with the fact that the Federal Reserve has kept interest rates at such low levels that it forced investors to place their money into the markets if they wanted any meaningful return whatsoever. This also coincided with strong earnings growth, which led to record stock market profits. However, now that interest rates are hovering near their highest level in decades, this author makes the argument that the price-to-earnings ratio would have to double from its current value in order for the stock market to post a repeat performance, nearly 40% higher than the tech bubble peak. Although, of course, there's also earnings growth to consider, because over the last 30 years, companies have benefited from declining interest rates and lower taxes. But to have another decade of record performance would have to include 6% real earnings growth, which is roughly the best ever outcome over a 10-year period during normal non-recessionary times. Or I guess simply put, don't expect that these types of returns will continue indefinitely.